Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel @Accounting Buddy NB. In today's lesson on depreciation, we explore one of the most essential yet often misunderstood topics in accounting. You will learn what accounting really means, including classic definitions by R.N. Carter and Spice and Pegler, and understand its true purpose and accounting impact. We will uncover its characteristics, important facts, and key differences from amortization and depletion. You will also discover why businesses charge depreciation, the concepts and the objectives behind it, and the factors that determine how it is calculated. Through real-life illustrations and journal entries, you will see how depreciation is recorded in practice, both when credited to asset account and when a provision account is used. Sit back, relax, and watch the full video till the end and be a master of the topic. Let us understand the meaning of the term depreciation. Depreciation is reduction in the book value of fixed asset due to wear and tear or efflux of time or due to obsolescence. Depreciation is the systematic allocation of the cost of a tangible asset over its useful life. It reflects how assets like machinery, vehicles or equipment lose value over time due to wear and tear, obsolescence or usage. Depreciation helps match the cost of an asset to the revenue it generates, ensuring accurate profit measurement. Depreciation is recorded as an expense on the income statement, reducing the taxable income of the business. Think of depreciation as the silent cost of using long-term assets gradually showing up in your books even if no cash leaves your account. According to R.N. Carter, depreciation is the gradual and permanent decrease in the value of an asset from any cause. In the words of Spicer and Pegler, the depreciation may be defined as a measure of the exhaustion of the effective life of an asset from any cause during a given period. Depreciation means allocation of depreciation cost, that is, the cost minus scrap value of the asset in a systematic manner over its estimated useful life. Depreciation is an expense for an entity and is transferred to the debit of profit and loss account to determine correct profit or loss for the year and to show the true and fair view of the financial position by showing the fixed assets at their fair value. Let us understand few important facts about depreciation. It is important to note that depreciation is charged on all the tangible fixed assets of the business which are used to generate revenue of the business. Tangible fixed assets are purchased by the business for long-term use. During the course of their use, every year a part of the cost of these tangible fixed assets is consumed or lost due to wear and tear, passage of time or obsolescence. The measure of this expired cost is termed as depreciation in accounting. The only exception of the tangible fixed assets which is not depreciated is freehold land, that is, the land owned by the business. It is because of the reason that the freehold land has infinite life while the other fixed assets have limited life. Let us learn key characteristics of depreciation. It spreads the cost of an asset to expense over its useful life in a planned, consistent manner. It represents wear and tear, obsolescence, or reduction in the value due to usage or time. Only physical long-term assets like machinery and building are depreciated and not land. It reduces asset value on the balance sheet and lowers net income on the income statement. It reduces the book value of the fixed asset except freehold land. Depreciation is provided every year because the book value is reduced either because of its usage or with passage of time. It occurs gradually unless there is a quick physical deterioration or obsolescence due to technological developments.
Depreciation reduces profit of the business but does not involve any actual cash outflow. It is not a process of valuation of fixed asset but accounting of expenses each year. The term depreciation is used for tangible fixed assets such as building and plant and machinery. The term used in case of wasting assets is depletion, and for intangible assets the term used is amortization. Depreciation is an indirect expense, therefore it is transferred to the debit of the profit and loss account of the business. Let us understand the terms depreciation, amortization and depletion. First, depreciation. It represents the gradual reduction in the value of the depreciable assets due to usage, passage of time or technological obsolescence. It is a systematic allocation of the asset's cost over its estimated useful life, treated as an expense in the financial statements. Depreciation is applied to all the tangible fixed assets with a limited useful life. However, freehold land is exempted from the depreciation since its useful life is considered as infinite. Amortization is a gradual and systematic writing off of the intangible assets over its estimated useful life. Patents, purchased goodwill, copyright, etc. are intangible assets. Its cost is amortized over its estimated useful life. Depletion is the value of the wasting assets extracted from the quarry or a mine. Extraction reduces the available quantity of the material. For example, extraction of coal from a coal mine is depletion of the coal stock. Therefore, always remember depreciation is applied on tangible fixed assets, amortization is applied on intangible fixed assets, and depletion is applied on natural resources. Let us learn the reasons and causes of depreciation. Wear and tear is caused by continuous use of physical assets like machinery, vehicle or buildings. The impact of wear and tear is gradual deterioration which results in reducing the efficiency and the value over time. Passage of time is another cause of depreciation. Even unused assets lose value due to aging and exposure to environmental factors. Natural decay or expiry leads to depreciation regardless of usage. Obsolescence is another cause of depreciation. Technological advancements or market changes make older assets less useful. As a result, assets lose relevance and market value even if still they are functional. There is certain assets which have limited useful life. Such assets are designed to operate for a specific duration or usage capacity. Therefore, in such cases, depreciation aligns with the asset's expected service life, say for example 10,000 machine hours. Damage or impairment of an asset is another reason for depreciation. Unexpected events like accidents or natural disasters results in sudden drop in the value of the asset. As a result, asset needs to be either revalued or written down. Let us learn accounting concept of the depreciation, that is the depreciation accounting. The accounting concept of depreciation means allocation of cost of fixed assets over its estimated useful life in a systematic manner. According to this concept, in an accounting period, a part of the cost of the asset is charged as an expense each year over the estimated useful life of a fixed asset. Depreciation is always charged every year and is transferred to the profit and loss account for the year to determine the correct profit or the loss of the business. In this slide, we will learn the objectives or the need for providing the depreciation. Most important objective of providing depreciation is to determine the correct profit and loss of the business. Depreciation is an expense of the business which helps generate business revenue and is therefore charged against the revenue. If it is not accounted as a business expense, correct profit earned or loss incurred for the accounting period will not be known. Another objective of providing depreciation is to show true and fair view of the financial position of the business. Balance sheet should give a true and fair view of the financial position of the business. If depreciation is not charged, it would result in assets of the business being stated at a higher value. As a result of this, the position statement, that is the balance sheet, would not present a true and fair view of the financial position of the business. To determine the correct cost of production is also an objective of providing depreciation. Depreciation is one of the elements of cost which is considered for calculating the cost of production. If it is not taken into account, cost of production will be lower by the amount of depreciation. As a result, sales price of the product may not be correct. Another objective of providing depreciation is to provide funds for the replacement. Depreciation is a non-cash expense, and when it is charged, the amount equivalent to the depreciation is retained in the business, and that can be used for the replacement of the fixed asset after the expiry of their estimated useful life. To meet the compliance requirements is another objective of providing depreciation. It is necessary to charge depreciation to comply with the IFRS accounting requirements and also to comply with the provisions of the Companies Act and the income tax laws. Let us understand the factors or the basis of providing depreciation. Factors involved in calculating the amount of depreciation are: number one, original or the historical cost of the asset. The fixed assets are recorded at the original historical purchase cost in the books of accounts. The cost includes the purchase price paid to the vendor, commission or the brokerage paid on the purchase, freight and installation charges, or any other cost incurred to bring the asset in the working condition. Therefore, the cost of the asset is equal to its purchase price plus freight paid plus its installation cost. For example, if a machinery is purchased for $700,000, freight incurred is $50,000, and the installation cost is $70,000, the total cost of the machinery will be $820,000. That is the sum total of the purchase price, freight cost, and the installation charges. VAT paid on the purchase of a business asset is not a cost of the asset. Asset amount is debited without taking into consideration the VAT paid. Depreciation is charged on the amount net of VAT debited to the asset account. Original or historical cost of the asset is another important basis for providing the depreciation. Residual value is an estimated realizable value of the asset at the end of its estimated useful life. Difference between the cost and the residual or the scrap value is the amount that is written off over the estimated useful life of the asset. Amount to be written off is equal to the cost of the asset less residual or scrap value. Useful or economic life of the asset is also another important factor for providing depreciation. Useful life of an asset means the period for which the asset is estimated to be productively used. Sometimes the legal provisions also become the basis of providing depreciation. Depending upon the country in which the business is operating, the local laws, company law and the income tax law prescribes the method and the rate of charging depreciation. While determining the amount of depreciation, local laws are kept in mind. Period for which the depreciation is charged is also an important basis of providing depreciation. Depreciation is charged for the period the asset is used in the business during the accounting period. For example, an asset is purchased on 1st of July 24. Depreciation for the accounting period 2024 will be charged for 6 months. That is, from 1st of July 2024, the date on which the asset is purchased, till the last day of the accounting year, that is 31st December 2024. Similarly, if an asset is sold during the accounting period, depreciation for that asset will be charged from the first day of the accounting year till the date asset is sold. Let us further strengthen our understanding of the concept of depreciation with an illustration. Tolly Trading Company purchased a machine on 1st of July 2024 for $150,000 from Poly Engineering LLC and paid a check to the supplier on 16th July 25 and also paid $10,000 for loading, unloading and carriage expenses to bring the machine to the factory. The firm further incurred $20,000 for installing the machine. Determine how much amount will be debited to the machinery account and pass the journal entries giving effect to the transactions. Let us find out the amount which will be debited to the machinery account. Purchase cost of the machinery is $150,000. Loading, unloading and carriage expenses of $10,000 are incurred. Further, $25,000 is paid for the installation of the machinery. Therefore, the sum total of all these three costs amounting to $185,000 will be debited to the machinery account. This means the cost paid to the machinery supplier plus all the costs incurred to bring the machinery to the place of business and to bring it into working condition will be debited to the machinery account. Journal entries for the transactions as per previous slide will be passed as under. On 1st of July 2025, business purchased machinery from Poly Engineering LLC for $150,000. The two accounts which will be affected by this transaction are machinery account and Poly Engineering LLC account. Machinery account will be debited and the Poly Engineering account will be credited by $150,000. On the same day, that is 1st of July 2025, business paid loading, unloading and installation charges for the machinery purchased. The two accounts affected by this transaction are machinery account and the bank account. Machinery account will be debited and the bank account will be credited by $35,000. On 16th July 2025, business paid to the machinery supplier. The two accounts affected by this transaction are Poly Engineering LLC account and bank account. Poly Engineering account is debited and the bank account is credited by $150,000. In this slide, we will learn about methods of recording depreciation in accounting. There are two methods of recording depreciation. First is under which the depreciation is credited to the profit and loss account, and the second is where the provision for depreciation or accumulated depreciation account is maintained. Let us first talk about first method under which the depreciation is credited to the fixed asset account. Under this method, depreciation every year is credited to the fixed asset account, which means the asset value will get reduced with the amount of depreciation credited to the asset account every year. Depreciation account is a nominal account under the traditional classification, or it is an expense account under the modern classification of accounts. Therefore, it is transferred to the debit of the profit and loss account. In the balance sheet, asset is shown at its written down value, that is the cost of the asset less depreciation provided till date. Journal entries for charging the depreciation and transferring it to the profit and loss account are: depreciation account is debited and the asset account is credited when the depreciation is charged on the asset and is credited to the asset account. When the depreciation is transferred to the profit and loss account is debited and the depreciation account is credited. Under second method, provision for depreciation or accumulated depreciation account is maintained. Under this method, depreciation is not credited to the asset account, but it is credited to the provision for depreciation account or accumulated depreciation account. Depreciation charged every year will keep on accumulating in this account. Under this method of charging depreciation, asset will continue to be shown at its original historical cost. The balance in the provision for depreciation account or accumulated depreciation account shows the total depreciation charged till date, that is from the date on which the asset is purchased till the end of each accounting year. In the balance sheet, assets are shown at original cost less accumulated depreciation till date. Journal entries passed under this method are: depreciation account is debited and the provision for depreciation account or accumulated depreciation account is credited when the depreciation is provided, and profit and loss account is debited and depreciation account is credited when depreciation amount is transferred to the profit and loss account.
In the next lesson on 3rd of January 2026, we will continue our journey into depreciation accounting with practical application. You will learn how depreciation affects both the fixed assets and the balance sheet, how to handle depreciation on additions and sold assets, and the key differences between the depreciation account and the provision for depreciation account. We will also dive deeper into the straight line method, its calculation, percentage rate, and the real life ledger preparation for multiple financial years. This lesson is a perfect blend of concept, calculation, and clarity made simple and visual.
If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share, and like my YouTube channel @accountingbuddy NB. Thank you and goodbye for now.